All right, hopefully you took a minute and you tried to do these on your own. But let's run through them, the solutions. Okay, so if you haven't tried to do it on your own, pause, do it on your own, and then come back. All right, 5.3. So here we are, third video. SMV purchased $500 of merchandise for cash. Cool. Debit, merchandise, inventory, credit, cash. Nothing weird. SMV purchased $4,000 on account. Terms N30. We'll get to that in just a slide or two. Well, debit, merchandise, inventory, credit, accounts payable. Okay, also pretty normal. And when they pay for the inventory that they bought, right, we're paying off this $4,000 that we owed, then we don't have anything to do with inventory anymore. We already have the inventory, but we have to pay the bill, right? So when we pay the bill, debit, accounts payable, credit, cash. Okay, we're not worried about the discount yet. That's N30. We'll get there in just a minute. Net 30. And the amount is paid in full. Okay, here we are. Let's talk about discounts. So sometimes these credit terms, they can be any credit terms, okay? But these credit terms, you would say 210 net 30. What it means is you get a 2% discount if you pay within 10 days. Otherwise, no discount, or you pay within 30 days. Okay? So what they're doing a lot of times is you can reward or you can be rewarded for paying your bill early. Right? Because what happens? A company wants their payment as fast as they can get it. So it might be worth it to offer somebody a 2% discount so you get your cash a little faster. All right. So we have to account for that, though. We're the accountants. So here we go. So the invoice paid within 10 days, right? 210. If the invoice is paid within 10 days, if it is, then you get a 2% discount. And the example for that is merchandise was purchased for $1,500 with credit terms of 210 net 30. Payment within 10 days is calculated as, if it was $1,500, they get a 2% discount on that. 2% times $1,500 is $30. And that means that they only really have to pay $1,470 for that $1,500 worth of merchandise. That's a discount. All right. The other piece of it, if you didn't pay within 30 days, then you just owe $1,500 for this example. Full amount is due in 30 days. All right. Like I said, these can be any terms. They can be 1, 15, N45, net 45. It's whatever discount you want. So it's percentage, number of days that the discount period applies to, or no discount, but how long you expect the bill to be paid. All right. So now that we know that, oh, I'm a little bit in the way. SMV purchased $2,000 of merchandise from its suppliers on account. Terms 315 net 45. I'm hoping you can see that, and it's not cut out on you guys. But it's 315 net 45. So when we make the purchase, we're just making the purchase, right? We're just buying the inventory. Merchandise inventory accounts payable. We don't know whether or not we're going to pay within 15 days. But let's see what happens if we do. Well, actually, we're not there just yet. We have one other piece. SMV then returned $100 worth of merchandise purchased in 4 because it was damaged. So basically, we bought $2,000 worth of stuff. We sent $100 of it back. All right, before we get into that, though, let's keep track. I've got merchandise inventory here and accounts payable. So let's get those 2,000 and 2,000 in there from that first entry. Now let's return the $100 worth of merchandise. So if we return it, we're going to reduce what we owe because we're sending back $100 worth of stuff. And we've got to reduce the inventory because we're sending it back to them. Makes sense. It's a reversal, basically, of the previous one. So let's get that new number in there, 100 and 100. Okay, so if we pause for just a second now. Whoops, hang on, too far. Okay, if we pause for just a second. Right now, we owe $1,900, right? We don't owe $2,000 because we returned $100 worth of the merchandise. So if we're going to pay for the merchandise that we purchased here, less the amount returned in 5, and the invoice is being paid within the discount period. So $1,900, but we are still going to take a 3% discount because the terms were $315. So we've got to calculate what that discount is. 3% of the $1,900 bill, right? We owe $1,900. We're paying it within 15 days, so we get to take advantage of that 3% discount. That winds up being $57. Cool. So how much cash are we actually going to pay? We're not going to pay them $1,900. We're going to pay them $1,900 minus $57 on the discount. So we're really going to pay them $1,843. Makes sense, right? So start with cash, right? Your journal entry. We've got a credit to cash for $1,843. That is the check that I'm sending in the mail to that company. But I have to take the full amount of the payable off the books. If I don't take the full amount of the payable off the books, if I just did it for a debit for $1,843 to match my credit, then it would look like I still owed them that $57, and I don't. So we have to take the full payable off the books for that $1,900. So now I don't balance, right? And that's not good. We know that's not good. The credit, I need a $57 credit. That $57 credit is going to be to inventory. Right? So here we go. Just follow my logic here. Now we balance. That's good. So we've got a $57 credit to inventory right here. So if we subtotal at this point, we have what we bought minus what we returned minus the discount. That means the inventory on our records as an asset is $1,843. Guess how much cash we paid? $1,843. So now they match, right? Remember the cost principle? The cost principle says we record the assets for what we paid for them. That's what we just did. We reduced the inventory by the discount piece, and now it matches the inventory, the value of the inventory on our records matches the amount of cash that we paid out for it. Kind of neat, huh? Okay. So, let's see. Do I want to do this one with you guys? Let's see. All right, we'll go through this one, but we'll go through it quick. All right, pause. Try it on your own. All right? Pause now. Then come back to me. Okay, so here we go. I'm just going to go through the solution. They purchased $185,800 worth of toys on account with credit terms of 210 net 30. So merchandise inventory, accounts payable, and merchandise inventory, accounts payable. They returned $18,500 due to damage. Okay, so we're going to reduce the amount that we owe. Accounts payable, merchandise inventory, same as we did before. We're going to reduce these two accounts. And now they paid the amount due less the return and the discount. Okay, so how much do we owe? Right now we owe $167,300, but we are eligible for a 2% discount. So we have to do that side math here. $167,300 at 2%. You've got a $33.46 discount. So you're not going to pay them $167,300. We're going to pay them $167,300 minus the discount of $33.46. But we have to take the full payable off the books. Remember, that full payable comes back, right? We have to zero that out because we're paying the bill. Now we're down to zero there. The cash we're paying out is the amount of the bill minus the discount. And the offset to that is inventory for the discount. So that makes our inventory $163,954, which is the same as the amount of cash that we paid. All right, so let's get on to shipping terms. Good times. All right, so I drew you guys. I made you a train because I think it's fun. Okay, freight terms. Okay, you've got FOB shipping point, FOB destination point. FOB stands for free on board. We're talking literally these terms came about in the days of trains. All right, so the idea is that inventory has to get from the seller to the buyer somehow. And who is paying for the costs? Who is paying for the shipping? Who pays for, when does the title transfer? Meaning, like, if it's sold, does the title transfer as soon as I stick it on the truck to go to you, to the buyer? Or does it exchange, whose responsibility for it is it while it's in transit? Or does title not transfer until we get to the buyer? Well, it depends on the shipping terms, okay? So this is all about when does title transfer and who bears the cost. Okay. All right, starting with the first one. What it is title transfers if the terms of the shipping are FOB shipping point. It means that title transfers as soon as the seller puts it on the Amex truck, or Amex truck. That's not right. On the, I had to pause for a second and think what I was talking about. Put it on the FedEx truck. Whew. All right, so obviously I'm unscripted, which means fun things sometimes. All right, so we put it on the FedEx truck. The minute we put it on the FedEx truck, it is no longer the seller's responsibility. It's gone, right? If a tornado picked up the FedEx truck and put it in another country and whatever, or the stuff got stolen by bandits, it is not the seller's responsibility. Their job was just to get it to the shipping point. So, with that being said, as soon as they deliver it to the freight carrier, right, whoever that is, whether it's the train, the plane, whatever, as soon as they get it there, it is now the buyer's responsibility to get it all the way to them, which means the buyer is paying the shipping because it's their responsibility. This whole trip is their responsibility. So if something were to happen in transit, too bad for the buyer. It's going to be the buyer's responsibility. Sorry, I clicked a little too far. All right. And that is, that's not unusual. If you think about it, a buyer, if you're buying a product, you may have to pay shipping costs to get it to you. And if that's the case, it's technically your responsibility to get it all the way to you. All right, so it gets added to the cost of the inventory when it is FOB shipping point and when you're the buyer, right? You get added to the cost of inventory. Because I want you to think about it for just a second. If you're buying something that cost you 50 bucks and you have to pay $10 in shipping costs, how much does that product really cost you? It really cost you $60, right? The $50 plus the $10 in shipping. You're willing to pay $60 to get that product. Well, that's what's happening here. Those costs then get added to the cost of the inventory, the shipping costs, if you're the buyer making the purchase, because wasn't 50 bucks, it was 50 plus the $10 in shipping. So it really cost you $60 to get your hands on that product. Does that make sense, I hope? All right. The flip side, FOB destination. Now the seller has to get it all the way to the buyer. So they have to get it all the way here. The seller has to pay for the shipping. So transportation costs are borne by the seller. The seller has to deal with it if anything bad happens along the way. All right. So if the seller is paying for the product to come all the way to the buyer, what we do is we consider that cost to be a cost of the sale, an expense of doing business. So, if we had to pay to get it all the way to the buyer, because that was the terms, we paid our $10 to get it to the buyer, then that is going to be a selling expense for us. That's just going to be simply, it's a cost of doing business. It's a cost of the sale. We're not adding anything to inventory or anything because that's not what we're doing. It is an expense. We're paying FedEx the $10. So be it. All right, so let's get to this with some problems here. Oop, nope, 11 minutes. Okay, next video.